Hello everyone and welcome back to another video. So this is the final video in our series and thank you so much for everyone who's watched up to this point. And it really means a lot and I hope that you guys have had a great experience thus far. So in this video we're going to be looking at one final thing and that's going to be famous investor strategies. So we're going to be analyzing value-based investing, which is conducted by Warren Buffett, followed by growth investing, which is conducted by Philip Fisher. So let's get started. What is value-based investing? So value-based investing is one of the most popular forms of investment because it is famously attributed to have created Warren Buffett's enormous wealth of over $80 billion. So value-based investing is what Warren Buffett credits the success to. And what it's really about is conducting fundamental analysis and identifying strong companies with strong growth potential that are undervalued in the market. So it's all about finding great picks and great companies that have great potential to grow, but at the same time are undervalued. So you're getting them at a great bargain. So what you're basically going to be doing, you're going to be conducting fundamental analysis and you're going to be finding stocks that are trading below their intrinsic value such that they also have a good growth potential. And then you ideally want to invest into those stocks and then hold them for a long duration of time. Warren Buffett has famously said that he likes to think that whenever he buys a stock, he will never sell it ever again in his life. So it's pretty similar to that. Whenever you conduct value-based investing, you're going to be a long-term investor within that company. So it's good to have a solid and intuitive understanding of what you're getting into. So just a few specifics about value-based investing. You're not going to let fear of missing out get to you. You're going to be looking at something objectively. You're going to be looking at it by the facts, by the books. Uh, you no need to put emotions into your investment strategy. As for waiting for the right bargain, you're going to be investing in stocks whose intrinsic value is greater than their market value, such that you get a good bargain. You take the time to find the right stock for you. You ignore the short term fluctuations. So it doesn't matter what's going on in the short term. You know that as an investor, if the company has potential, then you're going to be in that stock or you're going to be holding that stock for a long period of time. So who cares about what's going on in the short term, whatever fluctuations? It doesn't matter if the stock's going up and down. If you think it's a good investment and over the long term it'll play out well, then by all means go ahead. It doesn't matter if you make a short-term loss. Back in the Great Recession of 2008, Warren Buffett famously lost billions of dollars on paper when he decided to buy key quality stocks. He bought a lot of bank stocks, for example, that were trading far below that were trading far below their intrinsic value on the market. So they were they were bargains. But Warren Buffett identified through fundamental analysis and value-based investing that uh, those companies had a good future ahead of them. And as a result, he decided to invest in several of his famous investments, such as Bank of America. And that's a great example of value-based investing. He ignored the short-term fluctuations that were going on because of the volatility arising from the recession. So even though on paper, his investments were down for a period of time, and he lost a lot of money, or quote unquote lost. Uh, on paper, of course, he played the long game and value-based investing eventually prevailed. So value-based investing is all about just finding a great pick and holding it for a long time. And what do value investors look for? They want to make sure that they understand the business model and whatever business they're going into has a high quality product with great management, consistent growth in earnings that will lead to higher growth in stocks, and finally, shareholder oriented management. For example, buybacks of stocks, dividends, and so on and so forth, just to show to the shareholders that the company cares about them. So, several great examples of companies that appeal to value based investors are both Coca Cola and Apple. So here's the one final thing about value-based investing. One key thing is the economic moat. So it's something that sets the company apart from the others and prevents other companies from taking up their market share. And this could be a wide range of things. It can be patents, efficiency, recognition, size advantage, cost advantage, and so on and so forth. But essentially, whenever you're doing your fundamental analysis and looking for a good company to conduct value-based investing in, you want to find a company that has a nice economic moat so that you can get into it and it'll be successful for you. So that's basically it for value-based investing. That's the theory of it, of course. A common idea that's actually been arising in recent years with regard to value-based investing has to do with the idea of the bargain. So a lot of people are saying that value-based investing can be modified a little bit because in today's day and age with one of the longest bull markets in history and just a general sense of overvaluation within the stock market, a lot of people are believing that value-based investing no longer works because it's gotten increasingly difficult to find good companies at a bargain. Most of the time what happens is that these good companies are actually trading at levels of overvaluation. Well, with regard to that, once again, I'd like to say, just share some personal thoughts. Value-based investing can actually be tweaked a little bit to account for this situation. So, like I said in this lecture, value-based investing is all about finding a company with a good growth potential and a solid financial history, but also at a good price. Well, you can modify value-based investing such that even if a stock is overvalued, if you think that its valuation can continue to grow because of whatever fundamental reasons that can be backed up with good data, then by all means you should go ahead and buy into that stock. Mainly because if there is a good reason for it to go up, it most likely will. And the only and in today's market, one of the main reasons where overvaluation tends to be fatal is when you have a stock that's overvalued but without growth potential. So, like I said in my segment about fundamental analysis, overvaluation is not always a bad thing. If you have overvaluation but the stock can continue to grow, then that's also okay. So, yeah, so that's just one way that value-based investing can be tweaked a little bit, but that's still not to ignore the fact that value-based investing can still be used in today's market. You just have to look a little harder. But at the same time, if you look hard enough and you can find companies in sectors or industries that have been beat down or just are trading at unusually low levels, then you can definitely get a great deal and use Warren Buffett's value-based investing to your advantage. So in the next lecture, we're going to be talking about growth-based investing, but thank you so much for tuning into this one.